Great to see you again, Rich. Welcome.
Same here, Kelly. Good to see you.
You know, a lot of seasoned investors, hedge fund managers, these types tell me you never fight the tape. You know, they say that the tape is better than all these economic forecasts, and those, aren't worth much. And so why do you take a different view here?
Well, we think the stock market's in denial, at least large cap growth stocks, which are having a nice rebound, to your point, year to date from last year's disaster. But this whole immaculate disinflation theory, we do not espouse. As you all know, this is finance. It's not religion, right? And historically speaking, if you look at U.S. history, stocks bottom out during or after a recession starts, not 6-9 months beforehand. So we think with the litany, the laundry list of economic and financial indicators pointing downward, things are going to get worse before they get better. It's a toxic combination of decelerating growth and stubborn inflation. So at this point, the only debate that's valid in our mind, it's not if, but when the recession starts. It's will it be short and shallow, like a Kardashian wedding or marriage, or long and painful like a game of cricket? That's the only choice right now.
Don't offend the cricket fans. So I guess let me kind of push back a little bit more and choose the line that I often hear, which is, okay, well, we've been warned about a recession for 18 months now. You got to be invested in the meantime. Okay, stocks have gone nowhere for 2 years, but that's not, the end of the world. It's sort of this, the forecasters have been telling us for every month or 2 or 3 months that the downturn is coming, and yet the S&P is up 8% year to date.
Right. Well, we are winding our way through this economic cycle. Housing in recession, manufacturing statistics, the PMIs, the ISMs, as bad as we've seen since 07, 08. Now, certainly not saying it's going to get that bad, but the consumers, retail sales numbers in real terms, plateauing or even declining. Possibly we're finally starting to see some cracks in the labor market, and I think that's eventually what's going to turn this market around. Labor market jobs, as we all know, the last shoe to drop in an economic cycle. And if and when that starts to come down, I think we'll see equity markets wake up to the fact that things, again, are getting worse before they get better, and they'll reprice, especially with earnings headed where they are. I mean, you saw last quarter last year, and now this first quarter coming in, on average, earnings recession. All right. There are some bright spots, but for the most part, on average, we're talking about earnings declining by 3 to 5% or more.
And what I think is so fascinating about this, Rich, is your assets under management are over $200 billion. So it's one thing for the rest of us to sit there and go, yeah, it looks like it could get pretty bad. But you have to figure out what to do with all of that money in the meantime. Where is it? Where are you putting it right now?
How could you turn away 4.5% on the most creditworthy fixed income instruments in the world?
Well, hopefully most creditworthy.
Right. Well, we'll see what happens in the next couple of months. But I think we'll pull through that eventually. So you got a guaranteed 4.5%. If you want to move into high quality corporates, you're getting 5-6%. Shorter term. So you don't have to commit your money for very long. You don't have to take a lot of interest rate risk. This is the safe, smart play right now as far as we could see it. So we remain underweighted equities in favor of cash or near-term instruments in fixed income. But with that said, if our outlook for the recession comes to fruition, we have been migrating longer in duration. You're likely to be picking up some basis points at the longer end in the near future.
TLT trade, the good old, it's back. It's always, it's a TBT or TLT, and maybe the times have changed. Not that that's how you're investing. Rich, thank you so much for your time. We really appreciate it.